Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is the QQQ. That is an ETF that tracks the NASDAQ. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest.
All right, Lindsey, I'm going to start by just looking at the S&P 500 index. Last week, we were kind of talking a little bit about a trend line to the upside. We meandered through that trend line, and we did set a new high. One of the things that we highlighted last week is as we are approaching the top of this channel, we are seeing higher lows, which overall is a good sign for the marketplace. But today we did actually have a breakdown back into the channel. I'm trying to highlight it here a little bit with my cursor. And you can see that overall, that's not a good sign, but honestly, just in general, the market just seems to meander higher. What do we see going on in the markets this week?
Yeah, this week, Brian, the market obviously has been in the strong uptrend. We've talked about the momentum that the market's had for a while, and it is an interesting spot where you're seeing the chart lie right now. As we think about this week, it's a holiday shortened week. Yesterday was Labor Day. Happy Labor Day, everybody. I hope you had a nice, long, enjoyable, restful weekend. But as we look forward to the week, there's not a lot of economic data. We start conference seasons for corporations, but I think really what the market is focusing on right now, given that we're kind of in a news vacuum, really is the Delta variant, and then also what fiscal stimulus is going to look like going forward. The market, like you said, it's kind of flat to slightly down. We've got the Dow, NASDAQ in the red as we speak, but the NASDAQ, the Dow and the S&P 500 in the red, the NASDAQ is in the green slightly. So, but like I said, all really kind of more on the flattish side. Overnight, we did get some positive macro news from China export data jumping over 25% better than what was expected at 17% better than the prior month. So that's showing that there's goods are still being delivered outside of China, despite the port disruptions that we've heard all month about. But the Delta case variant question is weighing on investors' minds. So what we're really looking forward to here is what's going to happen from a fiscal policy perspective. We've got Congress returning from recess. So the focus on the debt ceiling and infrastructure bills and other monetary or other fiscal policy is really going to be at the forefront for investors. We did see yesterday that the federal jobless benefits expired. That's impacting about 7 million people. And then also there's about 3 million people losing state level benefits too. So a very close eye. We got to keep on the consumer, see if that spending that they've been doing and the pent up demand continues into the holiday spending season. The biggest thing this week, Brian, really is the ECB. They're meeting to talk about what their policy is going to be with tapering. We know that the Fed has basically more or less put that on hold until we get a couple more months of data. Last Friday's jobs report was very disappointing. And so most people don't expect the Fed to start tapering or at least announce a taper until November or December of this year. Originally September or October was potentially on the table. The ECB is in a little better shape than the US, at least from an economic perspective. So the marketplace is kind of anticipating some sort of clues as to when they're going to start their tapering. So we'll see, Brian. But this is the month of September, and we all know that investors get anxious in the month of December. It's the worst performing month for the stock market on a historical basis. Usually you see the market decline in the month of September. So far, we're about flat, only a couple days into the month, Brian, but we do see another area of green on the screen today is the VIX moving a little bit higher. What's that telling you?
All right. Yes, and the VIX is a little higher today. We see that up $1.35 or about 8%, and that's when we're looking at the S&P 500 index, which is a little bit flat, but we are seeing that run up in the VIX, and that could be because of the nervousness about the news on tapering and the big meeting that's going to be coming up this week. But overall, with such a light news week in general, kind of odd to see the VIX up this much on not a lot of news and a little bit of a down market. We actually have the NASDAQ flat at this point in time, and the Russell 2000 index is down about 0.5%. So if I do look out into the November futures contract, this is the symbol for the CBOE VIX index. It tracks the November future. We do see that that's up too. That's right around 2190, and then the December contract is at 2238. So the longer term futures are kind of creeping back up a little bit. So just showing a little bit of nervousness in the marketplace overall. Nothing too concerning by looking at the VIX, but it is up today on basically a flat market. So I know we're going to talk about the QQQs. So let me pull up a chart on the QQQ right now. And I'm just going to highlight a few things. Overall, the market has had a fairly big run up. So if we actually zoom back all the way to the beginning of the year, we had a little bit of a downturn. Then we've pretty much gone straight up, get a little bit frothy in the marketplace overall. But we do still have all the moving averages in line. We have the 200-day moving average below the 50-day moving average, below the 20-day moving average, kind of flattened out a little bit. What are we looking at in the NASDAQ and the tech stocks in general, Lindsey?
Well, before I get into the fundamentals, Brian, I want to remind our viewers, we were going to take your live questions at the end of the show. So feel free to type anything that's on your mind in the right-hand chat box here on the YouTube screen, because we're going to get to as many questions as we can. At the end, I see Clemson and Bruce in there saying hello. Anyone else, give me a wave. Let me know you're looking alive this morning. We'd love to see you active in the chat box if you can be. So thanks for joining us today. So looking at the Triple Q, like you mentioned, Brian, it's an ETF that tracks some of the tech sector in general. The chart, like you said, it's starting to look almost a little bit stretched over there on the right-hand side. You said the moving averages are falling in line, but it's getting further and further away, right? So we wanted to take a look at this. Technology has been a leader actually for the last 3 months. If I look at the S&P 500 tech sector, it's up almost 16% in the last 3 months. The best performing sector, like I said, communication services, which also houses some of your big tech names too, has done very well. Healthcare also has done well, and we've actually seen in the last month and a half, 2 months, the market has taken on a much more defensive posture. And we've talked about, Brian, you and I have talked about for probably the last year and a half, the technology has really acted as a defensive sector in this post-pandemic world, especially when work from home and technology became an even bigger part of everybody's lives. So what we've seen is as the Delta cases have increased over the last couple months, people have pushed back their return to work dates, right? I don't know about you guys, but our return to work date was supposed to be today. I'm in the office, but we've pushed back the date for the rest of employees that weren't volunteering. And I know a lot of companies have done that. And a lot of the technology companies have done that. Facebook, Google, they're not going back to the office until next year. So the work from home trade has been a bit of life has been breathed into that trade, and technology, of course, has benefited from that for that reason and for its defensive nature in this type of environment. So you've seen these stocks do well. The QQQ, like we said, has done extremely well over the last several months. But the question is, we've seen a lot of flows, a lot of money going into the QQQ. In fact, so much so that if you look at it on a 3-month rolling basis, the amount of money flowing into this ETF is at its 95th percentile. So that's very stretched, very highly bought into. And it's getting to the point where that could be a sign that because everybody and their brother is piling into this trade, it could potentially be a sign that the sector is overbought. Look, the valuation, if I look at just the tech sector, is still very stretched from historical average, still trading at an extreme premium versus the S&P 500. So that's why we wanted to take a look at the QQQ as a potential for the index to, or the ETF to trade neutral to potentially negative. Especially one thing we talked about last week was the 10-year yield. Interest rates have been on the rise over the last several weeks, potentially indicating that the bond market is expecting the impact from the Delta variant and the slowdown in economic data that we've seen over the last several months to subside and potentially take off again. So we're looking into that as a signal that growth could be resuming into the latter part of the year. And if that's the case, and if the 10-year is going to continue to rise, that's not such a good sign for the tech sector in general. So that's why, after looking at the chart, thinking about the fundamentals, thinking about where all the crowded trades and where people might go next, this might be a sector that comes under a little bit of pressure into the future. So that's why, Brian, you and I got together and we talked about a potential neutral to bearish trade on the QQQs. By the way, before I pass the baton to you though, Brian, just a reminder that if you dig into what's in the QQQ, the top 5 stocks make up 30% of the ETF, 37% of the ETF. And those top 5 stocks are, you've probably guessed it, Apple, Microsoft, Amazon, Facebook, and Alphabet, or Google's parent company. So that's what we're looking at when we're looking at this ETF. So Brian, what do you see as far as a trade goes? What would you put on here or recommend?
Well, as you mentioned, the markets just seem a little frothy. So we don't necessarily want to turn this into a speculative bullish trade. So we want to be neutral to bullish, and that's the terminology that you use. And that trade to me is a short call spread. Now, as always, this isn't meant to be a recommendation. We just see a little bit of frothiness with the VIX being up a little bit today. So we're going to go further out of the money, saying that, well, if the market goes up a little bit, we're still okay on this trade. And we're going to sell a short call spread. A short call spread is a bearish trade. It means that we want the market to stay where it's at or drift lower. That would be the ideal scenario. And we want time decay to work for us. So we're working on the fact that we're getting some good premium on the out of the money option contracts. And hopefully the market, if anything, just kind of stays where it's at. But if it does drift lower, that would be a good thing for the trade. We're not going to go out that far in time. We're going to go out about 17 days overall. So the short call spread means we're selling the more expensive option contract, and then we're buying a little bit further out of the money, less expensive option contract to protect ourselves overall. So if I go into the Ally Invest option chains, we see that we're up about 0.1% today in the QQQ. Here are the different expiration dates. You have a plethora of them to choose from in the QQQ, much like you do in the SPY, the SPY, the S&P 500 index overall. So we're going to actually do a Friday expiration date that is 17 days away. That expiration is September 24th. We're going to go a good bit out of the money. So first of all, if I'm looking at doing a short call spread, I want to make note of where the long straddle is at. The long straddle kind of gives you a hint as to what the marketplace thinks the potential move could be on this underlying stock for the next 17 days, or I should say ETF. And in this instance, you're talking about 10 points. So I want to go at least 10 points out of the money, or approximately 10 points. In this instance, the market has moved up a little bit on it. So we're going to look at selling the 389 strike call option. This means that the market just needs to stay below 389 over the next 17 days. And then we're going to go a couple points higher, and we're going to buy the 391, and that's going to be our protection. My whole goal here is that I want to get something fairly close to 50 cents. And a lot of times when I'm looking at these short call spreads, I'm looking at trying to bring in about 20% of the risk of the trade. So in this instance, we could make, in theory, then 52 cents if we could fill at the midpoint, and we could lose, the maximum it could trade for is $2. So we'll call it $1.50 overall. And I kind of like those ratios. It usually gets you right outside of the expected move because the options are always priced accordingly to what the marketplace thinks may happen. So it's all about probabilities when you look at the option prices. So we're going to make this the official paper trade, and then I'll show you the profit and loss graph on it. So I'm putting it in the right rail. And we're looking in this trade then to sell to open, the September 24th expiration, 17 days away, 389 strike call, and then buying the September 24th, 391 strike call. We're going to try to get a midpoint fill on this. The markets are really good in the QQQ, really tight overall. We have a 4.4 cent wide spread in general, so that's fairly good for two option contracts on one trade. So try to fill at a 52-cent net credit, no guarantee of that. The maximum you can make on a 1-by-1 spread would be $52 less commission. Maximum that you could make on, or the maximum you could lose on this trade would be $1.48 or $148 for every 1-by-1 trade that we did, and you'd have to add commissions onto that trade overall. So I'll just scroll down and kind of show you our profit and loss calculator shows where the market is at relative to where our risk is at. And let me go over here and hide the quick trade ticket. And we'll see this is where the market is at. It's highlighted by this gray line. This is where we want it to not go to. So anywhere from 389 down to where the market is currently at, we're okay. As a matter of fact, if it just kind of drifts forward in a week's time, we should have a decent amount of decay. So we're trying to make 50 cents overall on this trade. If I could get, or well, I should say 52 cents would be the maximum we can make on the trade. If I could close this out for 10 or 15 cents, I'm going to do that. I want to take the risk off of the table. That's my ultimate goal. So some people would just put this trade on. You have a high probability of success. That's why the ratio is the way it is, and that the maximum you can make is around 50 cents. The maximum you can lose is around $1.50 overall. And so you have a higher probability of success based off of the math on the option prices. So some people will say, well, if the maximum I can make was 50 cents, then if I can down 50 cents, I'm going to get out of this trade. And so that's one way that you can approach it to manage the risk. The other way is just to let it ride and say, all right, I have 50 cents worth of upside, and I am going to get as much of that as possible. If it starts going against me, I'm just going to let it ride and hope that it comes back. All right. So my preference is that you manage your risk overall, but at whichever way you decide to do, you want to stick to your guns. And when you're doing short call spreads, you want to apply the same theories and the same logic to each and every trade. All right, so that's it for the paper trade this week on the stock play of the day. Let's get to some of your listener questions out there. I see we got quite a few in the chat box, Lindsey.
Yeah, we've got some chatter in the chat box, which is always good. Hi, Kalia, Gavin, Mira. Nice to see you guys there. Anyone else want to give me a thumbs up to let me know you're awake and enjoying the show? That'd be great. But we do have a couple questions. Bruce, what is your stop loss or 150 IT?
What is your stop loss or 150 it? Okay.
I don't know.
Yeah. Well, the stop loss. I guess I think I answered that basically before you asked the question. Just in general, if the maximum I can make is 50 cents, and I'm looking at this higher probability trade, if it goes 50 cents against me, in other words, I see that spread, I would have to pay $1 to buy it back. I would think hard about just closing out the trade. And you just want to be consistent in your strategy. If that's your approach on all your short spreads, then that's the way that you should approach your short spreads. And that if the maximum I can make is 50 cents, if I am down that 50 cents, then I want to close out that trade overall. One of the things that's nice about the QQQ is you get those type of opportunities as opposed to an individual stock. Like say we were doing this in something like Microsoft. Microsoft has much more potential to go against you quicker than the QQQs. Now, the Qs can move without a doubt, but the odds of getting a 5% gap up or gap down on the Qs are a lot less likely than on an individual stock, like a lot of them that were mentioned here by Tim, Microsoft, Google, Apple, and others. the QQQ kind of dampens that volatility. So with a lot of the index and a lot of the index ETFs, I like to say there's some volatility with some probability, which is a little bit of an oxymoron, but they make good candidates for things like short call spreads, short put spreads, and iron condors if you want to combine them both.
All right. Awesome. Oh, he said, or is it $1.50? Okay, got it. Tim,
Okay.
that was Bruce, by the way. And Tim is now asking, how do you feel about CIBR, which is, I looked it up, it's the First Trust NASDAQ cybersecurity ETF. He says with Microsoft, Google, Apple, and others to help toughen US cybersecurity. Well, when I looked up this ETF, Tim, the top holdings are, it is focused on cybersecurity. So the top holdings are Zscaler, CrowdStrike, Accenture, and Okta, making up about, more than 20% of the ETF. And it's an ETF that's done extremely well. So it's focused more on that cybersecurity risk. It includes companies that are classified as cybersecurity companies by the CEA. And again, this is an important area of focus for the government, for banks, for companies in general. I don't know about you, but I've definitely received more phone calls and text messages about different, auto loans or mortgages, student loans that I don't have, that scam artists are much more prevalent these days than they ever have been. So it's an important area of focus. I don't know a lot about the ETF, but it does look like it's got momentum at its back. I don't know if Brian, if you pulled up the chart or anything, but yeah, it would be much different though than the QQQ, which we discussed today, because that's an ETF that includes all the mega cap tech names, like the ones I talked about. A lot of the FANG names are in there, carrying the heavyweight with Microsoft replacing Netflix. So definitely just a different story. It looks like this one might be getting a little bit stretched when you pull up the chart here. Thanks, Brian, for doing that. And looks like it had a big down day on Friday, but it's definitely something to consider. It's a hot trend, a thematic trend that a lot of people are investing in right now, for sure. I don't know, Brian, if you have anything you want to add.
Well, a lot of times, and I did not know of this underlying either, but I was going to check the options out. So we got our trade of the day in here. One of the things, if I'm looking at it, I'm a little worried, a little nervous about the liquidity of the options marketplace. And so if that's the case, I'm more than likely not going to be looking to trade it overall. The markets aren't too bad. They're not too rough. So it's plausible to trade some options on it. A little bit of open interest, a little bit of volume on the near-term option contract overall. So no real opinion above and beyond that. In that, I think part of the reason why the market's fairly decent is that they don't have weeklies. And sometimes that's a benefit in options, to have less choices if you want to trade them. I personally think that a lot of the exchanges put in too many weeklies on underlying stocks that don't have the volume to support it. And that makes the bid-ask spreads wide on all option contracts in general. So just interesting underlying, and thanks for drawing our attention to it. And I'll just leave it at that, Lindsey.
Yeah, sounds good. We'll definitely keep an eye on it going forward. And maybe in the future, we'll take a look at a potential trade on it. So thanks for mentioning it, Tim. We really appreciate it. Hey, Harry, nice to see you in the chat with the thumbs up. It looks like we're out of questions, Brian, for today. But I think it was a really good discussion that we had with our viewers here on an interesting trade, maybe a non-consensus trade. But it was a short trade, Brian, only going out 2 weeks. So I know on Friday, you're going to revisit the trade in your stock play of the day overtime show that everyone can tune into on Friday at noon right here on our YouTube channel. And you're always looking to see what's happened during the week and if it makes sense to make any adjustments, right?
Right. And we got plenty of time to make an adjustment. And that's one of the goals when I look at short call spreads. Sometimes I'll even go a little bit further out in time so that if we're incorrect on our forecast, we can make an adjustment. And that's one of the wonderful things about the options marketplace. And that's going to be it for this edition of the Stock Play of the Day. I will be back this Friday on the Stock Play of the Day overtime to discuss what has happened in the QQQ. Please click subscribe, ring the bell, and we'll see you this Friday on the Stock Play of the Day overtime. Thanks for coming, everybody.